So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies. If they pass my initial research, how do I value and evaluate them after reading their financial statements? I will go step by step, including valuations when we get to that point, and how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies. Hey, Jason here. Today's case study video, we're going to finish talking about ROIC, return on invested capital, and by showing you how to calculate it. Before I get to that though, I need to let you know that you can get this series as a podcast anywhere in the world for free on all major podcasting platforms, iTunes, Stitcher, SoundCloud, Anchor, Spotify, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. So in the last 2 weeks in our case studies, I've told you what return on invested capital is, why it's important, and today I'm going to show you how to calculate it, because there are multiple different ways to calculate it. This is the way you're about to see is the way I calculate it for every company I look at. Except for like insurance companies. I don't really calculate these for insurance companies, but for more normal companies, this is how I calculate it for every company. And this is the most important thing. Make sure when you calculate any metric that you use the same way to calculate it every single time you evaluate a stock. If you do that, then you can go back in time and compare and contrast the numbers to each other. If you use one calculation, for example, on one stock and one ROIC calculation on another stock, they're not really apples to apples comparisons because they contain different things. So make sure you use the same calculation every time you evaluate a stock. Okay, so I'm going to take this from my second screen over here. This is the value investing journey valuation and profitability metric template. This has a ton of stuff, valuations, metrics, pretty much everything I use and teach the students that isn't freely available anywhere else. I give away to students, but I also give it away to you. There will be a link below this. If you want this, you can get this and 4 other free gifts that will help you become a better value investor faster. And this guide by itself is 21 pages, almost 4,000 words, full of valuations, how I calculate profitability metrics, why I calculate them the way I do, how they compare to each other, all that kind of stuff. You can get this for free by going and using the link below this. So I'm going to take that away, bring this over here. Again, this is literally what I do every time I evaluate a stock. I just copy and paste and follow, even though I know this by heart now. Because I've used this for so long, I still just copy and paste it over. For now, ignore this. We'll talk about this a little bit later. But for now, ignore that part. Okay, so we're going to do this calculation on Microsoft. On 2 different companies, Microsoft and Disney. I picked why? Because frankly, they're 2 large companies that everybody knows. Equals, to calculate this, all you need, oops, my screen went away. There we go. To calculate this, all you need is the company's market cap, which you get on the main page. Sorry, not market cap. I'm thinking about value. You need their trailing 12-month operating profit, which you gave for Morningstar. Again, I'll show you all these in a second. Shareholders' equity, debt and debt equivalents, cash and cash equivalents, and that's on its balance sheet. So I'm going to pause this real quick and bring up those pages to show you where I get these calculations from. Okay, we're back. So I've got the 2 pages up. When you go to Morningstar, go to its main page, and let me bring this over here so you can see it. Okay. When you go to a stock's ticker, you input a ticker up here. To find this information, you go to the key ratios tab, which is, again, the quote tab is the first one to come up. You go to the key ratios tab, open that in a new doc or in a new tab, which is over here on my other screen. And you open up financials tab in your other screen. And that will get you to these, which I'll show you in a second after I calculate this number out. So let me do this. Let me X out of here. So I'm going to calculate this for you. I'm going to read, for now, I'm going to read off the information to you. Minimize this picture here. Okay, let's do that. Okay, so for this, you need the trailing 12-month EBIT, which is, in this case, also operating income. EBIT is also operating income. So in this case, it's in USD millions. Again, I'll show you this screen in a second. So, oops, I'll do that. Need to make sure I put this numbers. And the reason this is important, this right here, is because I want to go back at any point in time and know specifically what I'm looking at. So you'll see here in a second why this is important. So 52,959. So this is $52 billion, almost $53 billion. But if I had this if I didn't know what this was, I wouldn't know if this was billions, millions, thousands. I mean, with Microsoft, I would guess that it was billions, but I don't want to have to guess at all. I just want to know specifically what the number is. So next up, shareholders' equity. Come over here to the most recent quarterly info. Okay, so let me show you before I do that, so this number right here on the key ratios tab is the one you want. You want the most recent information when you're calculating this number. So that's why you want the trailing 12-month number. Okay. Now let's bring over this. Let me show you this real quick. This is the financials tab. You scroll, it starts over here. You scroll all the way over and you get here. So this is why this is another thing you need to be wary of. So these are in USD billions. So what I'm going to do is I'm going to fix on my sheet USD, put it in USD billions by doing this. And I'm just going to round up here. So we'll round up $53 billion. The reason I do that is to keep things straight. Because sometimes, again, even if you have it considered, especially for me, I evaluate a lot of foreign stocks. So the currency exchange rates are huge sometimes. So you're getting 10, 20, or 10 numbers in some cases for like Indonesian rupees is what I'm thinking of, Thai baht, stuff like that, that you can get some massive numbers in here. So typically I round up to make life on me easier. And so there's less opportunity for confusion. Okay, so shareholders' equity, that's all the way down at the bottom. That is 118.3 billion, 3 plus debt and debt equivalents. Scroll back up. So for this, you want short-term and long-term debt. So current debt and capital leases, they have 3.75 billion. 75. And long-term debt and capital lease obligations, they have 67.25. So that's 71 billion. And up here, I'm going to denote what specifically that was. Again, so I don't have to guess. Short-term debt and capital leases plus long-term debt and capital leases. Again, so I don't have to guess going back. I know exactly what went into this number. Minus cash and cash equivalents. We have $136 billion, $136.5 billion in cash. Oh, so see, I just messed up on my own thing. So I combined them here. But in the calculation before, this was short-term and long-term. So that's why, again, that's why I do what I do now. This is from an old example. And these right here are from this part of things, which again, we're not going to talk about right now. So get rid of that, get rid of that. What I would normally do is I would go back and change this to short-term debt in one and long-term debt in the other, just so I could kind of see the breakdown. But again, for your sake, and I recommend you do that, but for your sake and this video and not wasting time, I'm not going to go back and do that. So 136.5. Okay, and then you just do the calculation. 53. Plus 71. So 52.8. So I can tell you right now, that's pretty much 100% rounded up. So what does that mean? That means based on the best way that or the way I explain this to students is this means that for every, because frankly, the reason I'm having a problem to struggle with this is because frankly, you pretty much never see ROICs even approaching close to 100%. So that's the reason I'm having a problem or a little bit of a struggle explaining this. But normally when I explain ROIC to students, it's the amount of profitability. Remember, go back 2 videos ago. It's the profitability of a company based on its operating profits compared to its shareholder equity. Again, that's book value. When you add in its debt and debt equivalents and you subtract cash. So essentially what you're looking at here is what kind of profits the company produces based on its book value, or compared to its book value, essentially its assets, its net assets in this case, and how well a company is using its assets, how profitable it is a company is using its assets to produce operating profits. In this case, Microsoft is doing extraordinarily well. Again, I think I've seen this approach 100% maybe twice ever. And I promise I didn't plan this. I didn't look at the stock before this. But this means for every dollar, essentially for every dollar in assets the company has, that Microsoft has, it earns $1 in profits. So if it has $1 trillion in assets, all else remaining equal, of course it wouldn't remain equal, but it would earn $1 trillion in operating profits. That's how well it's using its assets. This is kind of a different story for Microsoft because a lot of its assets are not hard assets like a manufacturing type business. A lot of their stuff is intellectual property, software, stuff like that, which has more of a fungible value is the best way to put it. So keep that in mind when you calculate this for companies not based on hard assets, which speaking of, I'm going to do a different example below and show you the example for kind of a hard asset company. Instead of Disney. Disney does have some hard assets, but it's mainly, again, content and software and stuff like that. So this is what it means for Microsoft. Again, extraordinarily high. I think I've seen this maybe twice ever where it's been 100% or above. So fun for the case study. Again, didn't plan that. So I'm going to pause this again and find another company to look at and calculate ROIC for. I'll be back in a minute. All right, I'm back here with Procter & Gamble. Again, huge name. They sell many of the products we use in our everyday life. So they should still have a pretty good ROIC. but it should be quite a bit lower than Microsoft's because it's based on hard assets and physical inventory. One thing I wanted to make note of that I didn't mention before in the Microsoft one was to make sure you're always on the quarterly. You always want the most recent information. So you always want the quarterly balance sheet so you can see the most recent information. So one other thing I forgot to show you is that when you look at a company's ROIC and you calculate it the way I do, it will pretty much 100% of the time be different than financial sites like Morningstar. Why? Because I don't know how Morningstar calculates their data. Like I said earlier, there's a bunch of different ways to calculate ROIC. I don't know how Morningstar calculates their data. What is important is I know what goes into my metric and I use it to evaluate every stock. But note that they will be different. To show you that, I'm going to show you Microsoft's real quick. So I calculated Microsoft to have an ROIC of right under 100%. Morningstar has their ROIC calculation at 25%. Again, I don't know what goes into this number. I just know what goes into mine. And I've used this for 5, 6, 7, 8, 10 years. I don't know how long I've used this metric. So this is why I use it for every single one I look. Usually it's not this big of a difference, but pretty much the 100% of the time there is a large difference, or at least a small difference. Okay, so let's get back to Procter & Gamble. So we will need this number. So 15.4 billion rounded up. I'll bring these back over here for a second. I'll bring them back when I calculate the other number. So 15.4. Shareholders' equity. $45.9 plus short and long-term debt. So this time I'll actually write it out, the whole thing. Current, they have 12.7 plus 12.7 in short-term debt. I'll still leave that there. I will just take those out though, so I know that they weren't multiplied or added together. Plus 23.33 minus cash and cash equivalents of 15.4. Okay. So 66.5. That is 23.2%. Okay, so let's bring back the screen again. What did Procter & Gamble, Morningstar had Procter & Gamble's ROIC at 5.9%. I have it at 23.2%. Again, I don't know why there's a gigantic difference. Usually I evaluate smaller companies and the difference is smaller, but there is always a difference. So maybe for bigger companies with more debt, this and more cash, this obviously changes things because again, usually this difference isn't this big. What it means is Procter & Gamble is a fantastic operating business like Microsoft, and that for every dollar in operating profit this company produces, and every dollar of assets this company produces or has, that it earns 23 cents in operating profit. Again, generally you want this number, the higher the better, because it means, of course, that number goes up for every dollar the company spends. So this is exactly how I calculate ROIC for every company I look at. The one thing that isn't in here, which again affects why these are so different, is this. Operating leases and unfunded pensions. These aren't included in the kind of basic calculation today, frankly, because it takes more time to look at. You have to look at the company's annual reports to find this information. I'll talk about that in next week's video. I'll show you why you need to do that in next week's video. Or I'll show you how to calculate that and find that in next week's video. But for now, the reason you need to do that, you need to add these unfunded pensions, operating lease liabilities. The reason you need to add these things into the calculation, in my opinion, is because again, I'm thinking, if I'm going to invest in a stock, I'm thinking as if I'm going to own the entire business. If I own the entire business, let's say I go to buy the entire business, pretty much 100% of the time, you have to pay operating leases because it's things like leases on your buildings and property, major property and equipment, stuff like that. And unfunded pensions, you just have to pay. Legally, you have to pay them. So unless you want to pay a huge penalty to get out of your operating leases, you have to pay them. So I want to know them as a business owner or as an entire owner of the company. Same thing with pensions. You have to pay them. So I want to know about them as an entire operator or owner of the business. The reason I add it to this calculation is because I want to be as conservative as possible in my estimates, and because these are real world expenses that again you have to pay as a business owner. These would come out of the operational profitability of the company because you would have to pay these things to keep, again, stay in the building you own or that you're renting, and to pay old employees their pensions. You have to do this to continue operating. So that's why I include them in the calculations, and we'll see how big of a difference this makes in the calculation next week. Again, the reason I'm not doing it now is because you have to go to the annual reports, and I'll get that kind of all teed up for you next week. But I wanted to keep this short and sweet here. So we calculated ROIC for 2 companies we're at just under 23 minutes on this video, and I spent a lot of this time talking and teaching. So the actual calculations themselves, 30 seconds, a minute each, but you gain an enormous amount of information by knowing them. And most people just kind of take the Morningstar or the Yahoo Finance or MarketWatch information, and they don't calculate it themselves. Doing this, you not only know what goes into the metric, but you understand why that's important and how that affects the company's profitability. Plus, you can also compare and contrast that to other companies as well. So by calculating it, by doing the short calculation, you gain a huge advantage over other investors who won't take, again, a minute or two at most to calculate this number. So next week, we'll get into the unfunded pensions and operating leases and add those to the calculations, see how much these affect the valuations. Will keep the same companies, how much they affect the profitability metrics in their calculations. The links for 2 weeks ago video, that makes sense, I guess. What is ROIC, and last week's video, why ROIC is important, are below this. The link to get this sheet, again, the valuation profitability metric template that I give all my students that you can get for free. You can get this below at the link below as well. we'd really appreciate it. Like, love, share, subscribe, comment, and hit the notification bell once you subscribe so you're notified every time we release a new video. Sorry, and we're releasing new video. Same thing on the podcast. Like, love, share, subscribe, comment, and hit the notification, or not the notification. Hit the we'd really appreciate a review as well, because the more views, listens to, and reviews we get, the more people we can help with this kind of content. So we really appreciate that. Love to hear your comments on this. How do you calculate ROIC? Again, I've seen probably off the top of my head at least 3 or 4 or 5 other different ways to calculate ROIC. This makes the most sense to me. I'd love to hear your comments on ROIC, how you calculate it, all that kind of stuff. So below this. But until next time, we'll talk to you again soon. Have a great day. Bye.